Good morning. Well, they say when Powell opens his mouth,
good things happen.
What?
Good things, right? Something happens.
Let's wait. Let's try that again. When Powell opens his mouth, the market goes to shit.
Hey! All right. I could have beat you that time.
Yeah. Good morning, everybody. Brenden Rendo with the Homes in Orlando team, and is joined as always with Joseph Dionne of Appli Home Loans. And it has been a very tough week for the mortgage industry. And really, since the Fed meeting, we've seen nothing but an increase in rates. And every day is, quote, a new record, a new record, a new record.
Multi-decade highs. Like, these are the texts that I like to hear. We hit a new multi-decade high. Like, can we stop being the punching bag? Like, I don't want to take any more abuse in this real estate world. Like,
you feel like we were speaking earlier. I feel like such a broken record, and I don't want to be a broken record. I don't. But we keep looking at the fundamentals, and the fundamentals keep telling us there's no way to turn this down. Mm-hmm. I don't see where we turn this down. I mean, when we look at it, the 10-year, this is the chart of the 10-year Treasury note since Powell talked the day after the 21st.
Mm-hmm.
What happened? We took a shot up.
Bam.
Bam. A couple days, here's 25th is Monday. Happened to be my wife's birthday. Bam. Nice birthday present. Took a little dip. Okay, everybody take a breather. Maybe we'll level off. And then through the end of the week so far, we're on that continual increase. And like you said, last week is what's to stop us once we break that 4.5 mental barrier.
Yeah.
And there was nothing. And this just goes to show there's nothing.
That, like, what's next? Maybe 4.75, but really I think it's 5 on that 10-year.
Yeah, I
think that's what it is. I think the next barrier is going to be that psychological 5. And yep. But I think this is the market's reacting to Feds and everybody saying rates are going to be higher for longer. Mm-hmm. Like that's what we're getting out of this.
Yep, the neutral rate is going to be higher than we thought.
So I think that's kind of where we're sitting at right now. Is like that's the key.
And it's just you sit there, but what amazes me, you see this jump. You see the pullback.
Mm-hmm.
Another mortgage firm or lender I work with, Waterstone Mortgage, which is a good sized national firm. I talked to one of their loan officers yesterday, and they just went through layoffs yesterday.
Ooh, that's not good.
And why? It's because the volume naturally is going to pull back with the higher rates. Mm-hmm. And what amazed me is JP Morgan came out and said they no longer expect a recession. It's like, come on, guys. I can get that right because this is what you're looking at overall. Isn't this beautiful? This is back in 2021. The average rate was 2.66.
Yeah, that feels nice.
That feels really nice, doesn't it? And here's your well, actually, let's go down to the purchase. So here's your purchase volume for mortgage loans. And look at it go. Boom, 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 boom. I mean, they've got the average right now sitting at 7.19
on that report. But if you look all the way to the right of your screen, it's showing that 7.65 on that.
Yeah. Today's mortgage rates, 7.625.
Yep. So And that's top tier. This is, that little Mortgage News Daily, like they pull top tier pricing option. It's like, these are 80%, down 780 credit score, or, like you're talking, that's the best, Like, honestly, right now, there's a lot of buyers that it's like you're having conversations and you're throwing out a number that starts with an 8, or you're telling them you want this,
la 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 la.
you want this, it's going to be that. I talked to, and this is the hard part. I talked to a client yesterday, went under contract. He was under contract 2 months ago. And I felt so bad that I was like, oh my goodness, like I'm about to blow his, like he's about to have an aneurysm when I give him this rate, and it's like, you tell him what's going on with the market, you tell them, and then they get under contract and then it sinks in, right? Like now It really sinks in, like, because they think, oh, well, I'll still, but I was like, okay, let me get as aggressive, we'll go skinny, because I feel bad to tell someone, hey, I know that this house is 40 grand less than what you were putting, you are under contract on the last one, but your payment's going to be higher.
Mm-hmm.
Like, that's a hard pill to swallow, because they were like, they canceled the last one because they felt like the housing payment was too high.
Yep. And I had a similar situation in that I had a client who we were looking at the Hometown Heroes, and of course that's gone now.
It'll be back.
Not soon enough. Then
July, what is June of next year, technically, probably, because they're in session in January this time around for Florida. Yep. So they'll renew it. They definitely will renew it, right? Like going to the election cycle, like, it's getting renewed.
Yeah,
they're going to refund it, but I think the funds won't hit until July.
Huge success for the people who were able to take advantage of it. Truly got what I felt was a good program, mm-hmm. And a good opportunity to help exactly what's supposed to help people who are struggling to make that down payment.
Yep.
I just hope most of them realize that, hey, you do have to pay it back if you refinance or you sell.
Yep.
And this kind of goes into what we had talked about the refinances, is if we keep pushing the rates up, where that refinance level sits, because that's one of the things a lot of realtors present is, marry the house, date the rate. But if your neutral rate is higher, you're going to be dating someone you don't like for a long time.
Right? It's like, at what point, like, rates keep on climbing. And I'm not a huge, like, I understand the concept of marry the home, date the rate. Like, I get it. I do think it's super ultra, like salesy. I think it's one of those things where it's just like I feel like someone's like, do they really have my best interest when they're saying that? Like, I don't know. But like, I get it. Now, the hard part, like the key caveat to this is you better be okay with the payment you got today. Because if you're going into it and you're like, okay, well, I'm going to date that rate and I can stretch my budget to kind of afford this, but if something goes wrong, I'm screwed. Yep. You probably shouldn't be doing it.
Shouldn't be doing it.
Like, and that's the hard part. Because how, like, like last time rates were in the 9s was what? Late 90s?
Yeah.
Like, that's when they kind of like, I think it was like 2002-ish when they started to drop back down, got back into like sixes.
97, 98, I think. I remember the 8s. I remember the 8. I remember 8.25, 8.5.
I could be wrong. Like, maybe that's where it was. Like, I could be wrong.
Yeah.
You could be throwing, but like even still, like 8.5, that's where we are right now, right?
Yep.
Like, that's a tough, like, but what were values of homes back then? A house that's selling for $350 today probably was 80 grand back in 2000.
Easily. Easily.
And the hard part is where are our wages? Like, our wages haven't gone up to a level, like home values, inflation, everything else. Like, we talk about all these numbers, but the reality is that we haven't seen wage growth at a rate that matches everything else.
Yep.
the increase in everything else. Like, a dollar today just doesn't go nearly as far as it did 20, 30, 40, 50 years ago.
Nope.
I see all the memes that, the millennials or Z, whatever, all these younger generations, that are younger than me. There's younger generations than me now. Like, gosh, I'm a boomer. I'm right there. I'm almost a boomer. I'm like the boomer of millennial generation because I hate everything. No, but I see these memes where they're like, oh, my parents telling me that I should be more disciplined when they bought their house, for a nickel, right? And sold it for like $1 million, right? But it's kind of funny because, there is a lot of people, and you talk about, and I look at the average age of government, the policymakers, right? Senate, Congress, president, elected officials, you see all of this, and they're talking about, oh, well, we're doing this and that. And it's like, well, you're the ones to be trend, when you bought your house in 1980 and you're selling it in 2020, 2023.
Yeah.
That house that you bought in Silicon Valley for 100, 150, 200,000 is now worth 1.8. Yeah. You made one really good move. And I joke you were, the move was you were born in a generation that was able to take advantage of that, right?
Yep.
And I'm not being cynical but I think that's kind of the challenge that we have right now is
the younger generation, you've got 40% of them, I think it is now, roughly, that are saying, I don't think we'll ever own a house.
Yeah.
I don't think we'll ever own a house. And it's like, wow, that stinks because
wait, wasn't that the American dream?
That was the American dream. And that was like, okay, get married, have, buy a house, have kids.
Mm-hmm.
And I understand their discouragement because when you look at things financially, they've all been told they had to go to college, get a college degree, take these student loans out, you have to live up to everyone's means. So you've got all this credit card debt. And at the end of the day, it doesn't leave them with anything to buy a house with. I think that's one reason why you're seeing that multi-generational. I don't see it, we used to make fun of them, living in mom and dad's basement. Well, I understand why they're living in mom and dad's basement.
Mm-hmm.
Because I've got a 1-1 condo for a friend that I'm helping him rent out. A 1-1, $1,400 a month.
Oh gosh,
$1,400 a month.
Well,
and I have my phone is blowing up with people looking at it.
Yeah,
$1,400. Oh, okay. Okay.
Bank rate. I believe it was bank rate this past week came out with a statistic, and there's statistics you can believe whatever you want, but I think they said it was something like 67% of people of households making 50 to 100,000 a year are living paycheck to paycheck.
Yeah, and
then a third of people making between 100 and 150K are living paycheck to paycheck. Right? You got to think that's crazy.
Yeah, it used to be, once you broke that 6-figure number, it was like, hey, life was golden.
100K was the magic number. You made it.
It was the magic numbers. Hey, I got the 2 new cars. I got the house. If I want, I got the vacation home. Now
mm-hmm.
you go to the store and you walk out with a cup of tea, some hamburger and a couple other things, and you just drop $50.
Yeah. I mean, $50. Credit cards are up. How do you fill the gap? Credit card. And this is all coming out with what? It's coming out right now.
Yep.
We're talking a week before student loan payments are about to hit.
Yeah.
And I think, what was it? The average student loan payment that's about is
$502.
$502.
$502.
That's a car payment. Think about are you ready to add a car payment to your budget?
Oh, my wife was sending me some reels, and she sent this mom who's going out to buy, who's going to hand down her car to her son who was turning 16, and she was going to go get a new car. She went to the dealership, and the payment was like $928.
And she was like, I don't need that Kia Forte.
Yeah, she goes, well, he's getting a beater, try and find a beater for $2,000 these days. It's just, it's something.
It's definitely interesting. And I think we're going to see, I don't want to be all doom and gloom. Like, we're broken record, right? Like, there's some positive out there, right? There's got to be something. Like, the longer we sit at this level, the more, normalized it becomes, right?
Yeah.
Gives us time to adjust to it. We get to enjoy it.
And everything's going to adjust. It's just, well, you look at the UAW workers. I'm generally not a pro-union guy. I'll be honest with you, but they deserve it. They've lost, due to inflation, so much purchasing power.
Yeah.
That, okay, guys, I'm with you on this one.
What was it? Something like the starting wage for UAW workers like went down $2 in like the last decade.
Something like that, yeah.
Like, I was like, how have we seen the auto industry, which was bailed out by the government, decide, you know what? Like, hey, we're more profitable. We're racking in billions and billions and billions of dollars, and we're going to reduce wages. Like, that's the hard part. Like, and that's where I think we kind of run into, like, I feel like, I think a lot of people that are at the top deserve to be at the top. I'm never one to be like, but I feel like we're in a generation, like we're kind of in this weird environment where this is kind of before my time, but I feel like, you paid people more to stay with you because you felt like there was worth, and you valued loyalty, and companies valued these things and hard work, and you became more experienced. You did this and you got retirement, you have all these things. But I feel like we've created all these policies that has diluted the desire and has created an impact to where companies don't value loyalty. They don't want to see these things. They don't want to pay people more because it's like, oh, I gotta pay Tom more because he's been here for 10 years. So you know what? Like, I'm gonna hire someone fresh off the street for less.
I'll let Tom go. I'll take this kid, even though I have to train him because I'm going to save, $1,000 a month.
And that's the challenge, right? Like, I think we're seeing that, which, because you see that, I think we see wage growth kind of hold down because people never kind of work their way up. You think about the 401k. 401k was not designed to replace pensions. Like, the initial, like, that wasn't why it was designed, but they created it they designed it and realized that, wait a minute, we can replace pensions so that we no longer have to pay this, which saves the people of the company's money, and the people at the top makes them more profitable. And now the employee is responsible for that.
Yep.
Like, I mean, we got way off topic. I'm sorry. I get heated.
Yeah.
I'm sorry. How does it all impact us in the housing market? It gets Joe riled up.
Because sometimes you just, you got to say what you're feeling, and we're not the only ones feeling the same thing. We're not. There's more of us out there, and we're all trying to find a solution, all trying to figure out where is it going. But I mean, how is it impacting? Well, this is what I got this morning from Taylor Morrison.
Ooh, Taylor Morrison.
This is their quick move-ins, which come out on a weekly basis, right? Okay, ready now. Price cut $40,000, $39,776.
Wow.
Price cut $39,000. Price cut $12,000. But you look at this. This is pretty much where the median is. $381,000 house. It's up in Leesburg, but still $12,000 price cut.
Yeah.
Another one, $11,000. Another one, $15,000. Another one, $15,000. And they're still giving the incentives. They're still offering rate buy downs.
I'm pretty sure Taylor Morrison's Q3 financials. So what the result? When is that coming up? Is October 25th. Let's see how it looks from there. I'm pretty sure they're not going to have some positive news.
No. Well, we saw builder sentiment the past 2 months drop tremendously.
Mm-hmm.
But they're not the only one doing this right now. They are not the only one doing it right now. So, and, Black Knight came out with their updated August numbers, and foreclosure starts were up 21% from the previous month. The level's still below pre-pandemic, but a 21% jump, 31, almost 32,000 foreclosure starts in August.
Oh, wow.
So you look at that. So everything is affecting the housing market, and the job market softening up, everything. Everything's pulling back.
Mm-hmm.
And so is it affecting it? Yeah. You're seeing the builders starting to drop their prices. You've got foreclosure starts starting to push up a little bit.
Mm-hmm.
So we've got to hit that point where we hit the stall. We got to hit the plateau.
Yeah.
We've got to hit the plateau. And when we look at our Fed watch right now, this morning, this took a huge jump. Yesterday, we were at 77% for the November meeting, what they're going to do with rates. We just jumped to 83%. So a lot of people are looking what is going on with the economy, and they're like, "Ooh." They said maybe another. They're going to do a quarter point increase in one of the next 2 meetings.
Mm-hmm.
Well, I don't think they're going to. Here's November, and then we pop over to December, and this took a jump. We went from 57 to 62%. So the market is telling us, Al, we don't think you should raise rates. Is he going to listen? That's the question. Is he going to listen? And I really think a lot of this has to do with what we've seen over the past week with the 10-year yield. Yeah. And that spike that we've seen this past week in that yield. And I think a lot of people are just kind of saying, okay. You got to remember, Yellen's still scheduled to borrow. I think they still have like $800 billion left between now and the end of the year that they're going to borrow.
Wow.
So let's hop into our November this week's numbers for Orlando, and our single family homes decreased to 359, down from 398. Mm-hmm. And we saw a small increase in inventory, but we're still getting that increase. And then condos, they're holding at about 129. So this is what I'm looking at is, okay, we've got what, 100, 400. We have under actually 500 sales in Orlando in the past week. And look at this one. This one kind of blew me away this morning, because we always look at that original list to sales price, and look at the dip we took, 80 down to 89%. And final list, we dropped to 97. That was holding about 98. But where do we see the anomaly? Right here, in over $1 million. Somebody dumped their house. Somebody was in trouble, and they dumped their house because their original list of sales price, the average, remember they average these things out, but $897,000. Someone dropped the sales price on their house $1 million to sell it.
All right, which one was that? Come on. I know
I
you
gotta
deep
look that. I'm
dive.
gonna look that up.
You did the
I gotta look
research.
that up. I've got to look that up because look what happened to the original list, the sales price percentage. It dropped to 66%.
Yeah.
Someone was in trouble and they needed to dump that house. But then the other big thing, our days on market took a big jump to 46, which I was expecting this. We were expecting this to start seeing those days pull out as the rates push up. Then you see, sales price kind of down a little bit, but still kind of holding steady. But we see the rate increases. That's the end of the month. But here you see it. We're pulling down. We're pulling back.
Mm-hmm.
So our period average keeps dropping. I think we were 462 last week. And it's only 359.
Mm-hmm.
And then again, here's our inventory. Inventory's starting to climb. So this is pushing to we're pushing to a buyer's market very, very quickly.
Very quick.
And because we look at it this way is, like we said, we got the student loans coming in at $502 a month starting Monday. They get Sunday off, but Monday, here come the payments. So I think we're going to knock a bunch of more buyers out of the market. Then we hop into the condos, and you see this percentage is starting to drop a little bit. We're down to 96 here, and the average days on market has jumped as well to 40.
Mm-hmm.
And again, here's our inventory. We actually have 26% more condo inventory than we had in January.
Yeah. Ooh.
And when the days creeped up a couple days, and it's just we're going to continue to move in that manner as long as the rates continue to stay up this high.
Yeah, and I don't think there's anything that's going to be like. I think we might, like you said, I think we don't see the Feds increase the federal fund rate this time through, which leads what happens. Maybe no, I don't know. I think maybe we hit that plateau, but we're going to feel some more damage.
Yeah,
it's going to get a little
now through January,
and we're going to have rates at I don't want to say all time highs, but rates at high, all time highs for this millennium, right? 2000s, right? Yep. And then you're going into the slow season.
Yep.
And there's going to be nothing to catapult, stimulate sales. Historically, sales go down in the winter and spring, in the winter, and we're going to kind of hit that. And then they pick up in the spring, right? Rates are high. I think what we're going to see is it's going to be doom and gloom, so to speak. It's going to be a very, very slim picking type of next couple months into the early, maybe February of next year. And I think we see rates, maybe they do start to come back down next year. And that's what stimulates a buying season again coming for spring of next year.
Yeah. Well, as we saw last week, Powell took that soft landing off the table. He took it off the table. And so it's, we're coming in for that landing and it's getting bumpy. Hold on, guys. Hold on. So, seller, as a seller, price it right. And you may have to offer that incentive on a buy down. And to do it right out of the box. Offer a 2-1 buy down so that you've got an advantage over every other seller that's out there on the market that's trying to hold the price. It's what's your goal? How, can you hold the house? Are you willing to hold the house now? Because we're pushing up to that 45, 46 days, average on market. Remember, that's average. So there's some that are going, half the market's going greater than the 46 days.
Yeah.
So it's you got to sit down. You really got to look at it. Really look at your marketing. it's, I actually enjoy it because it's back to old school. You got to, we got to put together a good program here to make sure we get it done right, which is fun. It's a lot of fun. So,
yeah.
Well, we thank you for joining us. Have a wonderful week, and we will be all smiles next Thursday. Take care.
Have a good one, guys. Like, subscribe, share.